Someone is buying a massive amount of $20,000 an ounce gold call options. And you can see that right here, a huge influx of open interest around $20,000 an ounce. And a lot of people think that this is evidence that an insider knows that gold is going to be revalued up to $20,000 an ounce this year. So in this video, we're going to look at the evidence. Let's see what we have in the chart here. This is COMEX December gold option open interest by strike. Okay, and this comes from the CME and Bloomberg, so reliable source. So what we're looking at is basically a huge peak around $19,000, $20,000 an ounce for gold for December 2026. So importantly, what we see here is open interest. We don't know if the investor bought calls or sold calls. We don't know if they bought puts or if they sold puts. So every contract has a buyer and a seller, but we don't know who initiated the contract. So we know that there is a counterparty, and we don't necessarily know how they're hedging in other markets, but this could come from a bullish bet, this could come from a bearish bet, this could come from a hedging position, it could come from all kinds of things. So it's not necessarily the case of what's mentioned in the tweet here, that it's someone is buying a massive amount of call options. It could be that they're selling a bunch of call options just based on what's in the chart. Now, someone asked Grok what is going on here, and this is what Grok had to say. Reports indicate about 11,000 December 2026, $15,000 to $20,000 gold call spreads were accumulated on COMEX. Okay, so what's a call spread? These are bull call spreads that buy a call at $15,000 and sell a call at $20,000. Okay, so if you're not used to options, don't worry about it. Basically, a call option, if you buy it at $15,000, you make a profit if the price of gold goes above $15,000. Okay, so if you're buying a call at $15,000, you make a profit if the price of gold goes higher. And if you're selling a call at $20,000, well, you're basically saying that you're willing to give up your profits if the price of gold goes above 20. So above 20, you're not going to make anything. So basically, whoever structured this is going to get paid if the price of gold is between $15,000 and $20,000. And if the price of gold goes above $20,000, it's just like it was still at $20,000. Hopefully that makes sense. So how expensive was it to take on this bet? Well, the exact total cost isn't public, but estimates suggest a net debit of around $300 per contract times 11,000 contracts, totaling about $3.3 million to take on this position, and that's a low-cost, high-reward bet. So gold is currently around $5,000 an ounce. Okay, so that's what Grok says. I don't know how Grok is getting all that information. There is a bunch of reports out there. Maybe they're accurate. Let's just assume that they are, and let's move forward with this logic and see how big is the potential payday based on a gold revaluation. So what is the profit and loss of this trade? Well, for this particular call spread that we're interested in, the maximum loss is $300 per spread, and there's 11,000 spreads, so it's basically $3.3 million. That's the biggest loss you could possibly take. You can think of it like buying a lottery ticket for $5, and if you don't win the lottery, you're only out that $5. And if you buy 11,000 tickets for $5, well, you're out $55,000, but that's it. You can't lose any more than that. So your downside is capped. Your upside, interestingly, is also capped, but it's really, really high.
Reports suggest roughly 11,000 December 2026 call spreads were accumulated, structured by buying $15,000 calls and selling $20,000 calls. In simple terms, this strategy profits if gold rises sharply, but only up to a capped level. The buyer gains value once gold exceeds $15,000, yet any upside beyond $20,000 is forfeited. This is known as a bull call spread, a defined risk, defined reward strategy. It's not an unlimited moonshot bet. Instead, it's a calculated structure designed to balance cost and payoff. The positioning suggests conviction but also discipline, pointing to strategic planning rather than reckless speculation.
So the potential gain you could make on this trade is basically the width of your spread, so 20K minus 15K, that's 5,000, times the number of ounces of gold in each contract, which is 100 on the COMEX. So that's 5,000 times 100, which is $500,000, minus the cost that it took you to enter into that trade just for that one spread. So $500,000 minus 300 is $499,700 per spread. But again, you don't only have one spread, you have 11,000 of them. So you multiply that by 11,000 spreads and you can make about $5.5 billion, billion with a B, for a cost of only 3.3 million with an M in order to take that position. So potential payoff is absolutely massive. It's about 1,667x. So very big payoff here, hugely asymmetrical, and that in and of itself could be something that an insider would do, no question. So this doesn't, confirm or deny anything so far. So if an insider were to front run a trade like this, they would definitely buy call options, so they get paid if the price goes up, and they would be out of the money currently, so it would have to go to a much higher level, and it would be at a long time horizon like a year, and that's exactly what we see here. So far, it's consistent with that. However,
the estimated cost of entering this position is roughly $300 per spread, totaling about $3.3 million. That's the maximum potential loss. But the potential upside is staggering. With a $5,000 price window multiplied by 100 ounces per contract, each spread could theoretically return nearly $500,000. Multiply that by 11,000 contracts, and the payout approaches $5.5 billion. This represents an extreme asymmetrical profile, limited downside with exponential upside. Trades structured like this are sometimes compared to lottery tickets or tail risk hedges. The scale of the payoff is eye-catching, but structure alone does not prove intent.
this trade is really visible and a little too obvious. And I know that might not sound like a very compelling reason why this wouldn't be an insider, but think about it. If this trade hits, it's an absolutely massive payday. It's super visible. We can all see it. And it would trigger an investigation immediately. There would be an investigation for insider trading. And if it were an actual insider with phone calls and emails and some connection to whoever is going to make the revaluation, then they would get in trouble promptly. They wouldn't get to keep any of the money. So it's a little too obvious of a trade. It's very visible. In order to mitigate that, an insider would probably do a few things differently. They would probably use more varied strike prices. Instead of batching them right at 19 or 20, they'd probably buy at 12,000, 13,000, 14,000, 15,000, kind of smooth it out, make it look like a lot of interest everywhere. They would probably pick different expirations and not just December, maybe November, January, February, something like that. Possibly even February 2027, just buy something that's exactly a year out. And they probably wouldn't cap the upside. I mean, maybe they would. If they know it's going to get revalued exactly to 20,000, they might be willing to cap the upside because they don't need it. So maybe that's not that compelling of a point, but we probably would see more variety and diversification to try to at least disguise the trade a little bit. We would also probably see them using different layered accounts, and we just don't see that so far. So you might say, okay, maybe this trader has the regulators in his back pocket. Maybe he doesn't need to disguise all this. I hear you. That is absolutely a valid point. And so I would say to that, if that were the case, we wouldn't see matching put volume. So we have calls and puts, and in this chart we're looking at the calls are in gray. That's probably what jumps out at people as being the most interesting thing, because if you're going to front run a gold revaluation, you're going to buy calls, and then if the price of gold goes above it, you get paid massively. However, there's a bunch of puts here. Puts are in blue, and you can see that there's even more puts than there are calls. And if you were going to front run this trade, you would buy call options, and there's no reason whatsoever to buy puts. So you wouldn't buy puts, you wouldn't sell puts. It either costs money in one case, and in the other case, you'd have to post a bunch of margin. So you'd be tying up your capital for, I guess, 10 months or possibly longer. And there's no reason to do it. There's absolutely no payoff whatsoever. You're just either wasting money in one case or tying it up unnecessarily in the other. So it just doesn't seem to me like we would see so many puts, open interest, if this were just an insider.
Naturally, speculation emerged that this could signal insider knowledge of a major gold revaluation. On the surface, the pieces fit: long-dated options, far out-of-the-money strikes, massive convexity. But there's a problem: visibility. The trade is highly concentrated and easily detectable. If it were truly based on privileged information, regulators would immediately investigate such an outsized, obvious position. Sophisticated insiders typically diversify strikes, stagger expirations, and distribute exposure across accounts to avoid detection. This trade appears unusually concentrated. Its transparency may actually argue against covert knowledge, raising questions about whether the explanation is more conventional.
And if this were an insider, we would see evidence cropping up in other markets, whether it's bonds, foreign exchange markets, credit markets, and we don't see anything unusual happening in those markets yet, and it's already been a few days. So probably so far, we don't really see enough evidence to say, like, this is definitely an insider front running. It seems more innocuous, still a little anomalous, but more like a hedge fund or some other fund mitigating some risk rather than an insider front running a gold revaluation. So the most likely situation, in my opinion, is that this is a fund's lottery ticket or insurance policy, depending how you want to think about it. So it has extreme convexity, 1,000x payoff, like 1,600x. And like we said, the gains over $20,000 an ounce are forfeited. So that could still be evidence of an insider, no question. But I think it's also typical of what we would see in a fund. Also, it's only $3.3 million. That's the total cost to enter the position. So depending on your perspective, that might seem like a lot, but I think for an insider who had certainty on something like this, the position would be much larger, have an extra couple zeros on it probably. Also, the December expiry is noteworthy. It's interesting to start in February and then pick December. If you were an insider, you might pick, like I said earlier, several different months, several different expiration dates. And there wouldn't necessarily be anything special about December. Maybe November because of the election, maybe 1 year from now.
Another key detail complicates the insider narrative. Significant put open interest accompanies the call activity. Puts increase in value when prices fall, the opposite of a gold revaluation thesis. An insider expecting a dramatic upward reset would have little reason to accumulate puts. Their presence suggests broader positioning strategies, possibly tied to volatility trading, hedging, or structured spreads beyond what appears at first glance. Additionally, other markets, bonds, currencies, credit, show no synchronized anomalies. If a systemic gold repricing were imminent, correlated signals might already be surfacing across global financial markets.
And so what might a fund insure against? Why even have an insurance policy or a lotto ticket like this? Well, if you have a hedge fund, let's say, you have some kind of macro thesis, and it is your job to sit around and say, what could go wrong? What could go wrong? And depending on your thesis, you might have a few different things that could go wrong. For example, the dollar devalues massively, either because of fiscal policy or monetary policy, or some combination of the two. Those seem very plausible. You could have World War III or some equivalent escalation. Okay? You could have investors broadly around the world fleeing risk assets and buying gold. So obviously we've seen that to some extent so far, but even without an event happening or a policy happening, you could still have investors doing that in larger and larger quantities and faster. So that could happen. And really you could have any kind of black swan. You could have another virus, you could have a cyber attack. There's dozens of things we could put here as black swan events. And each of these could lead someone to choose gold. So gold is very rational and logical to have in your portfolio. And if you have a fund with hundreds of millions of dollars in it, it's totally reasonable to set aside 3.3 million of hundreds of millions and say, let's just have an insurance policy. If something goes really wrong this year by the end of the calendar year, by December 2026, let's have an insurance policy in place. Totally makes sense. And just a few other clues here. December isn't just a faraway month. So there is something important here about December. It's a major month for the COMEX. So there's tons of liquidity, a lot of transactions. That's very valuable to any kind of hedging position. It's also the year end, right? So it's the last month of the calendar year. So when you run your P&L, it's nice to have a lot of positions closed out so you have certainty on whether they made money or lost money. So it makes sense to close out that position before the end of the year instead of having open interest in February of 2027, which is 12 months from when you took the position, but you have that uncertainty at year end. Also, it's after November 2026 midterm elections, so that could be a data point that points in both directions. It's not necessarily strictly in support of one case or the other, but it is interesting. There could be some policies before November, there could be some policies after November. We will see. But in either case, a revaluation trade wouldn't be confined to December, whereas an institutional hedging play would. So that makes sense.
A more grounded interpretation may be institutional hedging. For a large fund managing hundreds of millions, allocating $3.3 million to protect against extreme scenarios is entirely rational. Gold historically acts as a refuge during currency instability, geopolitical escalation, sovereign debt stress, or unexpected global shocks. December 2026 is also a major liquidity month on COMEX and marks calendar year end, aligning with portfolio accounting cycles. Rather than secret knowledge, this trade may reflect prudent risk management in an era of rising fiscal deficits, geopolitical tension, and persistent inflation uncertainty. Sometimes what looks dramatic is simply disciplined preparation for the unknown.